everyone, and welcome back to another episode of the Recession Resistant Real Estate Radio. I'm your host, Brandon Cobb, co-founder of HBG Capital. And in today's episode, I want to talk about whether or not home prices are overvalued or more expensive today than they ever have been. It seems like everybody has a attention-grabbing headline out there about the housing market crashing due to interest rates and how mortgages are only going to get more expensive and home prices can only go down and it's going to be worse than 2008 and yada, yada, yada. And it just seems like the media is just feeding off of this attention that it's been getting since we've had such a hot housing market for so long. And the focal point of what I want to go over today is I want to shift everybody's thinking about how to determine whether or not an asset is expensive or inexpensive, because most people's focus compares that asset class to the dollar and how much your dollar buys of that specific asset class. When in reality, what you should be doing is comparing that asset class's value to a basket of other different assets to see whether or not it compares expensive or if it's very inexpensive compared to the basket of asset classes. That will give you its true determination of what its value is, if it's underpriced or if it's lower price. So we're going to jump into that. But before we do, if you get value from these episodes, please leave us a review and share with your friends and family. And if you've been interested in learning more about receiving passive income direct to your bank account secured through unique real estate investments, head on over to our website, hbgcapital.net. Book a call with us. We look forward to getting to know you. All right, so let's jump in. I got the opportunity to listen to a fantastic episode put on by Jason Hartman. He's the Chief Executive Officer at Empowered Investor. And these are some really good data points that I want to share with you. As you know, the best thing you can look at when making a determination of whether or not you should invest in something or get more defensive or pull out is whether or not it could be very expensive compared to the norms and is thus due for a market correction, or if it's very inexpensive. And the best way to do that is to compare it to a basket of other assets, not just the dollar. Let me explain and put this in another perspective. If you're dating somebody, you're not going to compare that one person to one other option that you had, one other person. You're going to compare it to as many people as possible to make sure that you make the right selection. Same goes for making an investment. You've got many different types of investments to choose from. You've got stocks, you've got bonds, you've got real estate, 20 different niches within real estate. You've got notes. And when you're investing, you're comparing the return on investment from one particular asset that you can invest in to another one because you want to see what's going to give you the best ROI. You compare things naturally to determine whether or not one asset class is undervalued and overdue for a increase in price, or if it's overvalued and it's due for a correction. We make comparisons. But we don't do this in real estate or stocks or some of the main cultural investment strategies that we use here pretty much in the United States. Stocks seems to be the main thing that everybody invests in, and a lot of times they're overweighted, and as a result, their portfolio suffers. So most people are seeing how much their dollar actually purchases, and instead, there are many different other assets that you need to consider when determining whether or not something is inexpensive or if something is very expensive. So that's what I want to do with home prices today. I just want to look at the data and I want to compare it to a basket of other assets. The first being gold. So gold has historically always held its value. It is a great measure of wealth. Gold has traditionally never gone to zero. People always have used gold for thousands of years as a store of value. So let's look at whether or not home prices are expensive or inexpensive if we priced it in historic gold ounces. So in 1980, if you take the price of your median home here in the United States and you divide it by the price of gold, it's going to cost you approximately 97 ounces of gold to buy that home. In 1990, it would have cost you 228 ounces of gold, nearly double of what it was back in 1980. In 2000, and this is really interesting, it cost $528 ounces of gold to buy a home. Home prices were ridiculously expensive, priced in gold in 2000. And then in 2010, it really went down to 158 ounces. As you know, real estate was very affordable. It was low, very inexpensive compared to the price of gold at 158 ounces. So what is it today? Well, today you can buy your median home for the price of 196 ounces of gold. That's like 40% of what it cost back in 2000. So compared to 2000, real estate is very inexpensive compared when you price it in gold. Let's look at the S&P 500, for example. In 1970, the median priced home compared to the S&P 500, it took approximately 249 shares of the S&P 500 to buy a home. Today, it only takes 75 shares. And that's after a very large decline that we've had this year in stocks. 75 shares today to buy a home compared to 249 shares. So, and historically, you can take this and look at just about every single decade. Historically, if you're pricing homes in the S&P 500, you're historically still inexpensive in your home price. Let's look at oil. Oil has been a store of value, and it fluctuates in price a lot throughout history. Back in 1970, it took 6,400 barrels of oil in order to buy one house. Today, it would cost you 4,500 barrels. So over time, since 1970, oil is still relatively high. In other words, housing has been relatively inexpensive compared to its historic norm when priced in barrels of oil. One other asset that a lot of people don't look at, but it is a great determining factor when comparing prices to things, because it's not easily manipulated, and it's pretty much eaten by like 2/3 of the world, and that's rice. So if we look at the price of rice and say, when has housing been inexpensive, or I'm sorry, when has rice been more expensive compared to rice historically? You only have two other times in history where housing was more inexpensive than it is today when compared to rice. That was 2010, right? Your rice, if you could literally trade bowls of rice for a house, or take the bowls of rice, convert them into dollars, and then buy the house. There are only two other times in history where in the number of, if you're buying a home in rice, it was actually cheaper to do it. And that was 1990 and that was 2010. So historically, it is a great time to buy real estate in rice. Real estate is very underpriced compared to its historic norm. One of the other important factors when considering whether or not something's overpriced is to look at the labor hours that it takes, because a lot of these, prices fluctuate. They go up and down. Some can be manipulated. But when it comes to hours worked, how many hours or how many years does it take to actually buy a home based on the median income? Well, if we look at 1970, it was right at about 2.6 years is what you would have to work based on your median income to purchase a home. Now, in 1990, it shot up to 4.1 years. In 2010, it was 4.6 years. And then if you look at today, it's 5.3 years. So it is a little bit more expensive compared to its historic norm. It takes more working hours in order to purchase that house, but it's not crazy expensive. I mean, the standard deviation is about 20% over what the average is. So we're not in crazy red zone area yet when it comes to the number of years you got to work to buy a home. So what does all this mean? Basically, if you compare the prices of houses today to a basket of other asset classes, it's still relatively inexpensive, especially compared to 1970 and compared to 2000. Now, what does this mean for the market? Well, unfortunately, I think that the housing shortage is only going to get worse as interest rates go up. I think that you're going to see the supply come down. You've got all these people that locked in a 3% 30-year mortgage rate. They're not putting their home on the market. They're buckled down. They are not going anywhere. You're only going to see people who absolutely have to sell. That is going to reduce the amount of inventory that comes to the market. And again, living arrangements are one of those things that continues. It goes on. You've got to have somewhere to live. And when people just can't afford things, they're going to get desperate. I think that you're going to see builders start building smaller homes to reduce the price. This includes us as well. We've limited our blueprints. Everything that we've got in underwriting is an 1,100, 1,200, or 1,300 square foot home. We're making sure it underwrites for a rental model. And, this is kind of funny because I'd always wondered why builders built those little 700, 800, 900 square foot, 2-bedroom, 2-bath, 2-bedroom, 1-bath homes. I was like, why would they build this? Like, who would want to live in this? And it makes sense when you had those crazy inflation rates in the 70s. And that's what people could afford. And if all people could afford was an 800, 900 square foot home, that's what the builder had to build in order to get it to the market and stay in business. It's making sense now. I think you're going to see homes get smaller and smaller and smaller. I think that you're going to see more people moving in to the houses that have these historic low interest rates locked in. I think house hacking is going to be more. If you remember back in the day, your mom and dad and your grandparents, it wasn't uncommon for a family of 5 to live in like a 2-bed, 1-bath home. I mean, that was almost normal in some areas. So I think as over time, we want more and more space. Our economy's gotten better. Our economic cycle has been in the upswing. It's been on a huge ride, the long-term economic cycle. As we drift into uncertain times, I think you're going to see people go back to kind of the old way and start piling into these homes. They're not going to have any choice because they're not going to be able to afford anything else. So basically, buckle up, because I think that the housing shortage is only going to get worse as time goes on. That's it for today. We'll see you on the next episode.